Welcome to the Ken McElroy Show. Today we're going to discuss the Fed is currently split on rate cuts, and December will be interesting. Ken and I also went to Las Vegas and spoke to a property manager, and we have some great insight there as well.
Yeah, I know. Well, let's start with the Fed because that's the one on everybody's mind. I saw that it's actually ticking up toward potentially a rate cut. So it was really like below 50%.
Yep. I think what they're doing is they're looking and they're seeing kind of the state of the economy and they're trying to balance it with inflation. And we've been talking about this for a long time where, the Fed has to decide between the economy and inflation. And it seems like some of the members are leaning towards focusing on inflation and some of the members want to focus on the economy.
Well, one of the things the Fed is wrestling with is the fact that the government shutdown didn't actually produce a lot of the numbers that they were supposed to be getting, right? Mm-hmm. And there's all these government agencies and analysts and economists and everything that they kind of produce things when you're on this treadmill, right? And then when that stopped, they don't have a lot of that data. So that's going to really play into December, I think.
It is. And they have to look at the facts. I mean, mortgage rates have been up. They're not really going down very much. Savings are at almost a record low. The job market is cooling off, and housing affordability just isn't there.
The one thing, though, I will say is we're heading into Black Friday. We're heading into this big, call it consumer month, I guess, right? 30 days of consumerism.
Yep.
Right, where people, for all kinds of reasons, they purchase all kinds of stuff for the holidays, right? And us included, right? It's kind of a thing, I guess. We've all fallen into it, but that does help.
Yeah.
It does help the economy. It puts people to work, albeit temporary, and it sells stuff.
It's interesting, though, because I keep asking different retailers when I go somewhere, how's business, and I keep hearing that it's a super slow holiday season so far. Be interesting once Black Friday hits and, once December hits. But so far, they're reporting they're really slow.
Yeah, the first half of November for sure. But, I think we're going to see some pretty robust movement here in the next 30 days. We got Thanksgiving right around the corner. We got Black Friday, of course. And a lot of people, they've got this new week called Cyber Week, right? Which is a new brand.
Well, I keep hearing everyone's shopping online for everything now. I've been hearing that a lot too, even from the people I go to the retail shops and they're like, well, I finished my Christmas shopping last night. I did it all online. So it's like, definitely a lot easier.
And we have friends that are in what's called the DSP or direct service providers for Amazon. And they're gearing up from employee wise. And like you go into these stores and they have, it's like a temporary help thing, right? You can make some pretty good money in a 30-day window. So now, it's not the real economy.
No.
I think that's a fact. But we are heading into probably a pretty good time. So I'd be surprised, and I'm going to go on record here because I think the Fed probably will lower about a quarter point. It'll be welcomed heading into the next year.
Well, let's talk about the two groups that there are in the Fed, because they're both making, very good points as why they hold their position. And honestly, because they have this dilemma of two things happening at once, a weaker economy with inflation, neither one of them are wrong. It just depends on which you prioritize. So we have Camp A, which is the cut sooner group. Obviously they're looking at inflation is cooling. It's not as hot and as high as it was, but it's still not 2%. It's about 3%. The job market is softening. We're seeing that, and we'll probably see that even more at the beginning of the year because that's kind of typically people don't like to lay off during the holidays. Real estate market being frozen. There's not a lot of activity going on, and you're seeing consumers are kind of maxed out. They don't have much savings. They're maxed out on their credit cards, so the economy really isn't moving much right now. So that's kind of what they're looking at and why they think that there needs to be a rate cut. And their fear is if they don't, if they wait too long, then we could put us into a recession.
Yeah. And I still think, every single day there's an article that comes out about AI. Right. And how it's displacing things that I never would have thought about. Like last week, I sent it over to our friend Jason, who is the executive chef at a incredible place here in Phoenix called the Global Ambassador. But there was an article about an AI chef in Dubai. And he's like, what? Check this out. It's literally, and so just when you thought AI was, kind of tackling them, kind of the I guess meaningless tasks for emails and inbox stuff and automation at a low level, you hear that kind of stuff and you're like, wow, I guess it really does and can go as high as possible.
Yeah, you and I kind of disagree on this because everything I'm looking at AI, it's doing some menial things like putting together recipes. It's great for looking certain kind of things up, but I don't see it taking over at this point too many jobs. It's definitely taking over some jobs, but it's not really like it was touted to be this big thing. And the results that they're getting so far is like putting together recipes or maybe, legal advice or, just stuff like that. But it's not really, it's not replacing a lot of jobs yet.
Well, yeah, I think you have a timing issue.
Mm-hmm.
So I read a Morgan Stanley report recently. They said it takes about 3 years for any kind of new, anything new like that to kind of roll out. The one thing that I just watched a thing with Gary Vee. I love watching Gary Vee. He's usually on the top of and the leading on stuff. He said Google ads are done. He said in the next 36 months, Google ads are going to be gone, and they're being replaced by AI and ChatGPT. So I think it's big. I don't think we see it all, and it's going to be interesting to see, how far it goes. And the only reason I bring this up is because one of the Fed's mandates is employment, and when you have, ticking unemployment up, then the Fed's going to be worried, and that's actually going to keep rates where they are. I think the one thing that we will start to see next year is going to be the year where employers are going to start to look at how can they grow without adding employees.
Yeah.
Because, okay, so that is the same as not hiring people.
Mm-hmm.
And so even in my own firm, we had a 1-day meeting last week, and I asked our accountant, I said, right now we have one accountant per 6 to 7 properties. That's kind of the ratio, right? How many properties one accountant can handle each month. And she told me, our CFO said, I think we can get this up to 12. So basically what that means is that accountant should be able to, with efficiency, be able to do twice the load. And I think that's what I'm talking about.
Right.
What I'm talking about, I'm not saying that there's these huge job losses. What I'm saying is that the businesses are starting to look at how they can do more and not actually hire. And they're starting to embrace this too. I think last year, or 2025, I should say, we're still in it. People are kind of toying around with it, right? But next year, I believe, is going to be the year that people start to embrace it. How can I implement this into my business? And because costs are going up, not just for people, but for businesses.
Well, that's what I was going to say is the reason businesses are looking at this, it's not really much different than a normal cutback in the economy, where people have to take on more of a workload because they're trying to skim on employees. But then now, right, you have this AI element, which does make it easier. Let's go into this can't be the wait longer group because, there is this other side of it where they're like, let's not cut rates. And the main argument here is inflation, right? And they're saying, we haven't hit 2% inflation. And if we start cutting rates, we run the risk of, creating a bubble in assets and making inflation worse for your average American.
Yeah. And the one thing that I think a lot of people can agree on is that we haven't seen the crazy inflation from the tariffs.
Yeah, so the tariffs that he implemented in April, they kind of rolled out in June to an extent, but I don't even know what the percentage is right now.
Well, I guess let's just move right straight to inflation then.
Okay.
Have we seen a real rapid inflationary?
No, it's at 3%.
Yeah.
And they wanted it 2%, but we argue if they'll ever actually get to 2%. But I think what they're worried about is we're teetering at 3%. So it's like if they cut rates, then what does it go to?
Yeah, and I think they got it out. I think it was down to 2.8 or 2.9 or something, and it's just kind of hovering right there. So yeah, to your point, it'll be interesting to see where that goes. But I think the bigger concern for me is the unemployment. If unemployment goes the other way, and I think we're going to have a pretty strong Q4, but next year, I'm telling you, this summer of next year, interest rates might not change much through all of next year. Very, very, very little. Half point here, quarter point here. That's pretty much what I think, based on kind of the push-pull of inflation and unemployment.
Yeah, I mean, it's really a high stakes, guess, right? Depending on what they choose to do, keep cutting rates or, not, right? Because if they cut too soon, you could have major inflation, which hurts the average American. But then if you cut too late, then you have job loss and a harder economy, which hurts the average American. So it really is such a balancing act. And, in the 70s, they cut too soon and they had major inflation. But yet, in 2008, they cut too late. And then that's when they had the Great Recession. Yeah.
And just in 2001 or 2021, when inflation went to 9.1, they raised too late, right? So they always seem to be, I guess we're trying to predict something and we just already know that they're probably going to be late.
They're always chasing, it's like they're always chasing everything, right?
Yeah.
So. The one thing they did right was in COVID, well, sort of, but in COVID, they cut right away. And then that prevented us from going into any kind of recession. But to your point, they raised too late. And then that's...
Yeah. And by the way, if you guys remember, they were doing 3/4 of a point, like bam, 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 like right in a row. I think we were over 2% higher just with 3 meetings. So, it'll be interesting to see. But I think the wild card for me is if I was going to use my crystal ball through 2026, is the non-hiring of AI, not necessarily cutting, the non-hiring.
Yeah.
And which is the same as, non-growth.
Yeah. And I mean, it doesn't go as fast as non-hiring, as cutting, but if somebody loses their job, it's very hard to get another one if companies aren't hiring. And I actually do think in the Q1, January, February, you're going to see a lot of cutting just because that's typically when businesses do it. They typically don't do it at the end of the year.
Yeah. There's a tremendous amount of commerce that happens in the last quarter, really, for tax purposes, for holiday purposes, and all this stuff. So I think Trump probably wants that quarter point cut. I would guess, it sets them off into a good start for 2026.
Yeah. And, we have to look at how this impacts housing directly, and if there's no cutting, then mortgage rates are going to stay elevated. I know that the Fed cutting does not automatically lower mortgage rates, but it does help, the banks make that decision. So, if they stay elevated right now, they're at about 6 to 7%, depending. For investors, they're about 6.5 to 7%. Those are very high rates. It takes a lot to make a deal cash flow in this market.
There's some uncertainty. We can't find real estate that's cash flowing, and the alternatives are squirrely.
It's a hard time to know where to invest as an investor because nothing's great right now, right?
Everyone's like, where should I go?
That people are just sitting on the sidelines. They're in commodities like gold and silver. That's why it's up. Part of the reason it's up. They're in money markets. They're in T-bills. They're literally just waiting because nothing really feels like it's worth the risk or worth the cash flow.
Yeah. And I that's exactly right. So I would say, you're in neutral, right?
Yeah.
The economy's in neutral. Consumers are in neutral.
Yep, they are. And sellers, when mortgage rates stay high, these sellers stay locked in. I mean, you're just not seeing a ton of listings. Most of the listings you're seeing, like we said, are flippers, Airbnb, second homes. They're typically not people in 2 or 3% mortgages because it really doesn't make sense to walk away from that.
But also, there's a lot of people are pulling things off the market. They're delisting right now.
Oh, yeah.
Right?
That's big. Yep.
Yeah. And so I would expect that you're going to see, second half of January, a bunch of stuff relisted.
Yep. I think you'll see a lot of things relisted, but I still don't think you're going to see the panic of selling either. I just think people are relisting it and they're just seeing if it sells, basically.
No, but I like being on neutral till about probably March, late February, mid-February, March. Because here's what, there's going to be, when people start relisting, that's going to increase supply, and then sellers are, you're going to have days on market increasing, right? So I think spring to summer next year is going to be an excellent time.
Yeah, and I think this 50-year mortgage product rolls out early next year, Q1, maybe Q2. And I think the reason Trump is doing that is it's not difficult for him to do. And the banks just have to agree to it. And it won't be fixed, most likely. So it's a good deal for them, too. And I kind of think that Trump sees the writing on the wall that interest rates are not going to significantly lower. So something has to give to try to make the housing market move.
I don't know about the 50-year yet. I'm still 50-50 on the 50-year. But I will, one thing is for sure is not working and will not happen is that portable mortgage.
Yeah.
That's, guys, I had I was on the Graham Stephan show last week, and we were having this conversation. I can't remember if it was live or offline. And I said, well, what everyone forgets is that the mortgage actually doesn't belong to the consumer.
Right.
It doesn't.
It's an investment.
It's not theirs to decide. Mm-hmm. I'm just going to take my mortgage and move it to another asset. Who cares about Bank of America? I know you don't really mind, but I'm just going to take your mortgage and move it over here. So that's for sure not going to happen. Mm-hmm. But the 50-year could.
Right. Yeah, that's the most likely. I know it's not everyone's favorite, but something's got to give, right? And the rates on the 50-year could potentially be lower than the 30 because it most likely wouldn't be fixed. Because that's what, in Canada has a 50-year mortgage and it resets every 5 years.
Yeah, the rate will be interesting, because there's been talk about maybe the rate could be even higher on a 50-year because the risk is higher, which again kind of defeats the whole point of a 50-year.
Yeah.
But they have 50 years in New Zealand and Japan and other countries, and so and they do work. And I think in Japan you actually can transfer that to your heirs.
Yeah, it's generational.
Yeah,
but their housing economy is a little different. They have a very slow housing economy.
Well, they do now, that's for sure, but. When you were a wee one, it was a little bit different.
So let's look at the different scenarios in which the Fed could cut sooner or cut later. And you mentioned the one, if unemployment were to spike or, job openings crash, then that could, or real estate freezes even more, then that could push the Fed's hand because they're very split right now. So they're really looking at all this data day to day right before December to decide what they're going to do.
Yeah, obviously that's an obvious one, right? And you already know where I stand there.
Mm-hmm. Yep. And I think with scenario 2, if there's any kind of spike in inflation, no matter what it's to, that could push them the other way.
Oh yeah, that's the other one, right? Yeah, the confusion around tariffs and all the other things.
Yeah, it's going to be interesting. It's a big deal, even if it's just a quarter point, because it's showing their positioning, right? Are they focusing on the economy or are they focusing on inflation? And so it will be telling and interesting to see what they do in December.
And one of the things I think could affect a non-rate cut, even though I predicted there would be one, is going to be the lack of data. If you take a look, they rely on data, certain data, and when the government shutdown happened, then obviously they have less data to determine. And again, if that would be me, I'd probably go neutral.
Well, here's the thing. If they don't have data, they actually have to pull some of their data from other sources too, like just common sense, what's happening right now.
That's sources. What they're doing.
And that's what they're going to do. But everyone's going to look at different sources for that, So it'll be interesting, It's a big deal for those that say that what the Fed does not directly, affect mortgage prices. I know that it's more the bond market, but at the same time, rates are down quite like half a point since they started cutting. So the banks are they do use that information as well.
Yeah, it does trend. It's not direct, like you said.
Right. So we had a fun 24 hours in Vegas last week.
Yeah. Neil got to experience my normal pace.
Oh my God. We literally we filmed our live in our podcast, went to Vegas.
Yeah, we filmed at 10. Filmed at 9, took off at 11, landed at 12. Hit the ground running.
And we were supposed to get all ready and have this nice dinner, and we didn't have time. So we ate at the bar, made it to our comedy show, and left the next morning. So
perfect night.
But it was fun. We went on the Graham Stephan podcast, as Ken mentioned. He's awesome. Him and his partner, Jack, they were great.
Yep. Two young guys, just got full of piss and vinegar. I loved it. And Graham's really, 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 educated himself on a lot of stuff. So he really knows a lot about a lot. He pours himself into the knowledge side. It was impressive.
And Jack, he tried to act like he didn't know much about real estate, but at the same time, he syndicated a deal and put his friend in his house that he bought. The back used to be a church, but the back lot, they made their podcast studio. So
it's pretty cool.
Really cool.
Yeah, they're scrapping it out just like I was at that age. It's neat to watch, and it's fun that they can talk about it.
Yeah, it's totally great. And it's a great, inspiration for young people, because I think Jack's 27, 28 years old. Nothing, no, inherited money or anything. He's just scrapping it out on his own too. So.
Yeah. I asked him, I said, how old were you? I was talking about the GFC in 2008. I said, how old were you? He looked at me, he goes, I was 10.
I know. You guys gave him so much crap for that. 10 years old.
But I just love it, Wow.
Really, really cool.
Good guys.
So while we were there, though, we decided obviously to make a work trip out of it since we were flying out there. And we met with, Ken has a property manager. Ken owns a couple condos in Vegas. And so we met with his property manager, and a few different things, were interesting on his take on the property.
Well, let me back up. So 20 years ago, Ross and I did a 440 unit condo conversion on this project. So we bought the property. It was an apartment building, and then we converted it to condos. And I did that. I did several in Las Vegas. And what we would always do is we would keep the models, right? Because you need models to sell condos. And so we would buy them. We would buy a couple units personally, and then we'd furnish them, and then thousands of people would go through them. And so, fast forward, I bought them all cash 20 years ago. I still own them, and I hadn't seen them in forever, right? And so I went up to meet with my property manager, Tony Taranto, and I said, Tony, let's go take a look at this project. I hadn't been on it in over 10 years.
Yeah, and it was very interesting. So Ken has 2 units. He's had a couple guys running one unit for 15 years. They've been there for 15 years. Talk about, good tenants, right?
Zero vacancy in 15 years.
Yep. And then the other one, Ken had a squatter in because it was vacant. And the reason for our meeting with him is we were considering selling it. But what he let us know is, the Vegas market's a little bit soft right now. And he would probably put a renter in there and hold it.
Yeah. So what happened was, just like anybody, I guess, the renter moved out, and during that period of time, a squatter moved in.
Yeah.
So they had somebody, and they had the classic where they had the electrical cord out over the wall, plugged into some common area plug, and but by the time Tony caught it, which is within inside of a week, he said it was pretty trashed.
Yeah, and they had already moved out.
Right? Then he cleaned it up. And then they moved in again.
Oh, I didn't know
Yeah,
that.
It happened twice.
They're sweet.
Yeah, he's like, I'm not sure how they're getting in because it's all locked up, but
right.
We figured it out. But anyway, so somewhere along the line, I lost my fridge, so that's gone. So I hope somebody's getting good use out of it. So. Anyway, it was kind of fun, but it was fun to go on this project and look around. Because when I finished the property, I did the roofs, I painted the whole project, we redid the landscaping, we redid the parking lot. And the first thing I did is I'm looking around going, okay, this thing's a little tired.
Well, so this is what was interesting. So we were there, and this guy thought we were looking to buy. He thought Tony was our realtor. And so he comes up, and he lives there, and he's like, this place is so great. Our HOAs only went up $5 in the past 5 years I've lived here. Oh, $50 in the past 5 years I've lived here. And it's amazing. They're so great because of that. And Ken's looking around, and he's like, the parking lot needs redone.
There's millions of dollars of deferred maintenance on the project. I can see easily $300,000 or $400,000 just in the tree cut. I mean, by the way, this is 440 units. This is 40 some acres. It's a big project.
Yeah, but it was interesting. So Ken's looking at, we might get hit with a special assessment, and this
Yeah.
guy's thrilled. He's only been, up $50 in 5 years. So there is that balance for those that like hate that their HOA keeps going up. It's also a problem if they're not making it go up, because then they're not fixing things on the property, and they're gonna have to eventually.
Yeah, that's right. That's right. But at the end of the day, we ended up we're gonna throw a renter in there because, as you guys know, and as I've been saying, right now it actually is a great time to be a landlord if you own something, because even though it's soft right now on the rent side, I do think that we're going to see some serious rent growth here in the next few.
Yeah, and that's the interesting part, like somebody like Ken or just anybody that's in I have a condo right now that's, at 2.8%. I'm going to be listing it next year, but if I don't get what I want for it, I'm just going to put a renter in there. I mean, I'm not going to like fire sale it, and that's where the situation that most people right now with a mortgage are in is there's no need to fire sale it. Like, you can stick a renter in there, or you can stay yourself, and,
Well, when I said to Tony, of course, I've owned these for 20 years and all cash. I don't have any debt. But I said to him, I don't know what I would do with the money.
Yeah.
Right. Like, which is kind of what we talked about on Monday on the live, right? That's the thing. Like, everybody's scrambling to figure out, what should they be doing with their money? I mean, if you take a look at the S&P's down 20% almost in a month, Bitcoin's down 22% in a month. You start to look at these things, and so that was what I was calculating in my brain. Like, okay, if the market was opportunistic, I probably would have made a different decision.
Right. And, people might hear that and say, oh, Ken doesn't need the money. But it's like, no, that's not the point. The point is what would I do with the money? Because, like, if Bitcoin's, softening and the stock market's softening, and you're only going to get, 3% in a money market, maybe, like, what are you really going to do with the money that would pay? It makes more financial sense just to have somebody be paying rent in there.
Yeah, and if I'm seeing inflation and high unemployment, then I actually probably want to be right in the rental space, right?
Yeah. So it's very interesting.
And we went around the market, took a look, and that market is six weeks free right now. 6 weeks free for a 12-month lease. And so it does show up when you're trying to buy something. And it's interesting because I got into this conversation with Graham. He's like, well, why would you buy something like that? I said, I get where you're coming from. People want, what they really want is they want the best deal that cash flows, right? And so those two things oftentimes don't work together. Mm-hmm. Sometimes you have to buy in a market that's challenging. Mm-hmm. Right. And
because that's why you're getting such a good deal on the property.
Deal, right. And that's what I was trying to say. So people are like, well, I got a text from Robert Kiyosaki this morning about something about Vegas, and I'm like, yeah, exactly. That's he goes, what should I start buying in Vegas? I go, yes, that's exactly why I'm buying in Vegas. Is you want to buy when things are moving the opposite direction. Mm-hmm. It's also one of the places, if you look at that people are moving in the U.S. right now, if you look at migration patterns of where people are going, Las Vegas is up there. People are moving there.
Yeah, and like with this property, the Vegas downtown is not where most of these tenants are. Most of them work in the hospital. Most of them want to be by Summerlin, which is a nice area of Vegas, a nice suburb. So it's not all just casinos and hotels and that part of Vegas. And the other thing is that, to your point, people read headlines like Vegas is, down, it's empty. It's, it's always so exaggerated because they want clicks. But then people think, oh, this is a horrible time to buy here. But they want to buy when everyone's moving, to Vegas. It's a hot market. And then they overpay.
But let's just put that in perspective. We were just there. Was that your experience? That Vegas was down and there weren't a lot of people there?
No. I mean,
no.
Yeah.
We were at the Cosmo. It was jammed.
Yeah.
And we were trying to fly out of there because why? Because F1 started the next day.
But it wasn't even an F1 crowd. It was really like the Cowboys had a game there, so they had a bunch of Cowboy
the Monday Night Football.
Yeah,
the Cowboys played the Raiders, and so I'm just telling you guys, like I'm not trying to pitch you on Vegas. I'm just trying to say that we were just there, and the place is rocking.
Well, and it was interesting because we always like to talk to the Uber drivers, right? Because they know, right? They pick up rides, they understand it. And our Uber driver said, yes, it's slower. It's been slow all year compared to the last few years. He goes, but it's not dead. He goes, I think I'm down about, 15, 20% in my, annual profit so far. And he would kind of know. And the truth is that just because something's slower doesn't mean it's crashing. It's just like the house. It's just this clickbaity titles. It's like, yes, the housing market's slower than it has been in the last couple of years. It's not crashing. Yes, Vegas is not as busy as it was the last couple of years. It's not dead. Like, you know what I mean? Like there's still activity going on. It's just slower. And that's what economies do. They ebb and they flow.
But I will tell you, having lived in Vegas, I do love, that's the one city I watch. And I'll tell you why. When people are feeling stressed financially, they cut out a Vegas trip.
Mm-hmm.
That's a really important thing. They decide not to fly there, rent a room somewhere, go to dinner, go to a show, go out to a club, whatever. But there used to be the $1,000 rule where, if you fly to Vegas, you spend at least $1,000 on, all in on something, right?
Mm-hmm.
So it is interesting. And where it shows up in Vegas is actually in the hotel rates.
Mm-hmm.
That's where you see it. When you start to see discounts with the big casinos and the big hotels, that's when the Wynn Hotel or Caesar's Palace or Aria or Cosmo or when you start to see that, you're going to start to see some softness, and so that's where it shows up first.
Yeah, but they're also going through a generational thing because, as these Gen Z kids and even some millennials, like they're not drinking, they can gamble from their phones. Like there is like less of an incentive to go to Vegas in the first place. So they're having to rewire their economy a little, which is why I think they brought in, the football stadium. It's why they're focusing they're getting a lot of big performers for the shows, because gambling, while it definitely attracts people, there's a lot of places to gamble now.
It's a heck of a point. I mean, when we walk around, it's like it was everybody our ages.
Yeah.
At the tables,
right?
It's not the up and comers,
mm-hmm.
and casinos, casino gambling, and then even in Scottsdale here, we've got a DraftKings. It's a whole sports book, and of course you can do everything from the phone now,
mm-hmm.
and so there's a race obviously on the tech side, but so that is another good point.
So why don't you explain to people why you like Eli in Vegas and why you're investing in the Vegas market?
Yeah. So first of all, I have a history of living there and watching the economy rise and fall, and it's been very, 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 very strong for a long time. One of the things I like is that it doesn't have a lot of excess supply,
mm-hmm.
right? So you always look for, is it oversupplied? And while it's being absorbed right now. So this particular area is where you want to be. It's off of Fort Apache, and it's up in the Summerlin area, and that's where the growth is. That's where the high end stuff is. That's where the growth is. And so we're at Main and Main, right? That's number one. Number two, we're buying it below replacement cost. So if we were to build that project today, we're buying it at easily $50,000 per unit below. So, call it $10 million less than it would be if we were to build it. So those are the two factors. And also you cut through all the red tape of the construction, the entitlements in the city, and all this stuff you have to do, the contractors. So we're basically buying a brand new building that's at the tail end of a lease up. And it's struggling right now to maintain occupancy because it's still kind of dealing with the excess supply that hit that area as well, because it's the area in Vegas that you want to be at. So, but there'll be a time where that all gets absorbed. And so, I figure when I buy an asset like this, I figure you should budget for at least 2 years of softness, right? Of struggle, of management, trying to get tenants and all that kind of stuff. And there's nothing wrong with that. as long as because we're long-term holders, right? I'm not trying to sell it 2 years or 3 years or 4 years. We hold buildings, over 15 years. So I don't know how long we'll hold this one, but we'll see. But we're budgeting for it. It cash flows today, but not what I wanted to, and so we're budgeting for that.
If you're accredited and you're interested in investing in Eli, just go to mccompanies.com/Eli. That's ELY. See you guys next week.
All right.